Good morning, Karen. Thank you very much for having me here. I think for a net interest income after a very strong 2023, what we expect is a stability going forward and hence to maintain our level of profitability. This quarter, we have achieved a return on tangible equity of 15.6%, up from 9% last year. And this is the kind of level we expect for next year, 2024.
Just talk us through some of the activity levels, because as interest rates start to move higher over the course of 2023, as we saw, some of the volumes were impacted in many markets. But I can see if I look at your book, that commercial activity was still strong through the year. So just explain some of the volumes and activity you're seeing despite the high interest rate levels.
Indeed, it has been a challenge to deal with this new rate environment. But I have to say we've been very satisfied to see that we have still been able to grow our business loan book, our consumer lending loan book. Yes, we have had an impact on the mortgage front that's directly related to the higher interest rates. But then when you look at the customer fund side, we have had a very strong year in terms of assets under management, up close to 19 billion euros in a year. So it means we're doing well relative to others. And also it means that if in a rising environment, we've still seen some decent level of activity. Now that we look into 2024 with a better rate environment and lower rates in the horizon, then we should have a higher rebound in activity. So I think it's pretty good news.
Gonzalo, I'm just pouring through the numbers, going through as many pages of the 80-page report as I can. But one thing that seems quite dramatic is year-on-year, fantastic improvements. But quarter-on-quarter, things have really slowed quite aggressively as well. Do you feel that actually the next quarter is going to be even more difficult, actually, and that we've seen, as you and Karen were saying, we've seen the high benchmark of banking profitability in Europe for this cycle?
Well, I wouldn't say so. I think you're right, Steve, indeed, that quarter on quarter what we've seen is a stability. This is what we project for 2024. And this is basically related to the fact that it's good news for the economy that interest rates have stopped in the way up. And now we're going to see a couple of quarters of stability. Then we will see them coming down. There will be some impact more into 2025 on lower rates rather than 2024. But for the time being, what we see is a stable environment in a new level. This 15% level of return is something that we see sustainable going forward.
I once upset a senior banker at Credit Suisse by saying that his cost-income ratio was out of control. It seems the complete opposite here. So credit where it's due at 40.9. That seems one of the lowest cost-income ratios I've seen in the banking sector. Correct me if I'm wrong, sir, but you must be quite happy with that level.
We are indeed, Steve. We've actually reduced our cost-income ratio, which is obviously moving it into the right direction. The lower, the better, from the 50% area last year to 40% now. It's a huge improvement in one given year. I'm not surprised. Our institution is the largest institution in Spain with 25% market share. We've gone through a large, successful merger that delivered us more than 1 billion of cost savings. So now we're reaping the benefits. That's it.